China has been one of the largest foreign holders of U.S. Treasury Securities, a position it began to establish in earnest in the early 2000s. But before we get started, please don't forget to smash that like button for me because it helps me make more videos and it helps the YouTube algorithm. This relationship was deeply rooted in the economic strategies of both nations. The U.S. needed a dependable buyer for its debt to finance its deficits, while China sought a secure place to invest its vast foreign exchange reserves. The U.S.'s status as the world's largest economy, along with the perceived safety and liquidity of U.S. Treasuries, made them an attractive investment. This relationship was mutually beneficial. China purchased U.S. debt, helping to finance American consumption, while the U.S. offered a stable return on China's foreign reserves. Over the years, China accumulated over $1 trillion in U.S. Treasury securities, peaking around 2013. This significant holding gave China considerable leverage in international financial markets and provided a cushion against economic uncertainties. However, it also made China vulnerable to changes in U.S. monetary policy and fluctuations in the value of the U.S. dollar. Despite these risks, China continued to purchase U.S. Treasuries, seeing them as a vital part of its economic strategy. However, in recent years, there has been a noticeable shift in China's approach to U.S. debt. Concerns about the sustainability of U.S. fiscal policies, rising tensions between the two countries, and changes in global financial markets have led China to reconsider its holdings. This shift reached a critical point when reports surfaced that China had sold off all its U.S. Treasury holdings, a move with significant implications for both economies and the global financial system. China's decision to sell off its U.S. Treasury holdings did not occur in isolation. Multiple factors likely contributed to this monumental decision, reflecting a mix of economic strategy, geopolitical considerations, and financial market dynamics. Understanding these factors requires a closer examination of the evolving relationship between the U.S. and China, as well as the broader economic environment. One primary reason for China's decision may be concerns about the U.S. fiscal outlook. The United States has been running substantial budget deficits for years, a trend that was further exacerbated by massive spending during the COVID-19 pandemic. This has led to a rapidly increasing national debt, raising questions about the long-term sustainability of U.S. fiscal policies. China's leadership might have concluded that holding large amounts of U.S. debt was becoming increasingly risky, particularly if they believed that the U.S. dollar could depreciate in value or that the U.S. might encounter difficulties in servicing its debt in the future. Another key factor is the escalating geopolitical tensions between the two countries. The U.S.-China relationship has significantly deteriorated in recent years with conflicts over trade, technology, human rights, and military presence in the Asia-Pacific region. This growing rivalry has likely made Chinese leaders cautious about holding too much U.S. debt, which could be used as leverage in future conflicts. By selling off its U.S. Treasuries, China might be aiming to reduce its vulnerability to potential economic sanctions or other forms of pressure from the U.S. The global economy has been experiencing significant changes, with new opportunities emerging in other markets. In response, China has been diversifying its investments, seeking higher returns in different asset classes and regions. The rise of digital currencies and the push for the internationalization of the Chinese yuan may have also influenced this decision, as China aims to reduce its reliance on the US dollar and promote its currency as a global reserve. China's sale of US Treasury holdings carries profound implications for the American economy. The US government heavily relies on foreign investors, including China, to finance its deficits. The sale of these securities could lead to higher interest rates, increased borrowing costs, and potential disruptions in financial markets. The immediate impact of China selling off its U.S. debt would likely result in a sharp increase in interest rates. U.S. Treasury bonds are considered among the safest investments globally. and their yields serve as a benchmark for other interest rates. If China were to suddenly sell a significant portion of its holdings, it could flood the market with treasuries, driving down their prices and pushing up yields. Higher yields would mean increased borrowing costs for the US government, potentially worsening the already considerable budget deficit. The ripple effects would extend beyond government borrowing. Higher interest rates would raise borrowing costs for businesses and consumers, potentially slowing economic growth. The housing market, which is particularly sensitive to changes in interest rates, could be adversely affected, with higher mortgage rates leading to lower home sales and a slowdown in the construction industry. In the broader economy, higher interest rates could reduce consumer spending and business investment, potentially leading to slower economic growth or even a recession. China's sale of US Treasuries could undermine confidence in the US dollar. As the world's primary reserve currency, the US dollar and US Treasury Securities are key components of central bank reserves worldwide. If China were to sell off its holdings, other countries might follow suit, leading to a broader sell-off of US assets. This could put downward pressure on the dollar, resulting in inflationary pressures in the US as the cost of imports rises. Now, if you like this video, check out this next video right here.